Business Morning. Joining me now is Bismarck Rewane. He's a financial analyst and economist at Financial Derivatives Company, one of Nigeria's leading financial services firm. And we're looking at the performance of the Nigerian economy in the first quarter of this year. That's between January and March this year. Thank you so much, sir, for being here. I know, of course, one of the things your company does is track the performance, key economic indicators in the economy, from the capital markets to all of the key economic indices. Now, for you, how would you rate the performance? We'll go into them one by one, but generally, how would you rate it?
It's a mixed bag, but generally speaking, it's very good this quarter. And in analyzing this, I'd like to take it into three segments. One, what are the leading economic indicators? The leading economic indicators, which are before the cycle, would show that estimated growth for the first quarter, slightly down to about 6%. Why? This is because we had a strike for about 10 to 12 days in January, so that brought down output. Aside from that, we also had a drop in power generation, which is still affecting productivity. But oil production is up. Oil price is up by over 14%. The Naira is stable to appreciating. Interest rates have spiked. We have a decrease in money supply. The budget has been approved, and the president is here to sign it, but approved by the National Assembly. Demand for foreign exchange actually declined because of the reduction in oil demand. We've seen a 50% increase in the price of petroleum products because of the 40% reduction in the subsidy. The amended cash light program kicked off, even though with some problems. Our external reserves have increased to a record high of about $37 billion, with some diversification into the yuan. We got an outlook for the economy was revised upwards by Fitch and Standard & Poor's. And some oil licenses were renewed, principally ExxonMobil and Chevron at this time. The PIB task force has been set up to review items. The Pension Commission has revised some of its guidelines. There was a circus called a capital market probe. You just talked about it, in which was basically a lynch mob. But that is to start again on Monday. We just heard in the news that it's going to be on Tuesday. It's going to be broadcast live because of the credibility of the House. The stock market had actually gained some, but during the probe, it lost about 1.9% because investors were scared as to the developments. Some banks have announced spectacular results, primarily GT Bank and Zenith and First Bank. We've seen inflation decelerate, went up to 12.6 and now down to 11.9.
Okay, 12.6 from the previous quarter down to 11.9. Latest figures, okay, from the MBS.
So, generally speaking, I think it's positive. On the coincidental indicators, the real estate, which had declined sharply, occupancy rates were high, have actually started picking up again. And we're seeing some strength in the real estate market again.
Now, of course, we knew that we did get some headwinds at the beginning of the year, where the partial removal of the fuel subsidy, and of course, all kinds of analysis were done as to where inflation would head, going forward. Even the central bank governor did say that we should hit it between 14 and 15%, but the NBS, the National Bureau of Statistics, came out with this very surprising figure, 11.9%.
Yeah.
Of course,
that's for February.
That's for the month of February. Okay, we haven't had that for the month
March.
of March.
For March, I think that it's not going to go too high, but it's going to be definitely higher than that of 11.9% in February. But in any case, even if we get to 14%, it's still within the natural level of which we can accommodate, considering all other factors.
Now, you did say that we did have a weaker drop in credit to the private sector.
Yes.
How was that impacted the economy as well?
Well, the point is that with interest rates, if you had government bonds at 18%, and that is the federal government of Nigeria borrowing at 18%, 10-year bonds and 7-year bonds, and top companies like MTN and Chevron and others borrowing at about 15 or 16%, you'll find that investors would rather buy government bonds than buy private credit. Now, what has happened is we've seen the level of subscription of government instruments increase. In fact, the Treasury bill over subscription last week was at 155%, and about 4 weeks ago we had a 300% of our subscription. That means that people demanding government securities are queuing up rather than going to the private sector. This will, as we go along, will kind of equilibrate. That is, the rates we're going to come down, and then the rates for private credit begin to go up, and then there will be some balancing of portfolios.
Do you think that perhaps that should be like a major source of concern, where we're literally having the federal government crowding out, the private sector, corporate bonds? I mean, I know it's meant to provide a good benchmark and a yield for others, but if we're having a yields as high as between 14 to 18%, of course, who would go to the others?
No, don't forget that we had a rate of inflation that went up to 13%, and so the interest rates were adjusted to rein in inflation. Obviously, there was an overshoot in terms of 18%, but that's coming down. If you look at the budget, the total debt service provision was actually 599 billion at an average rate of 10.89. In fact, the Debt Management Office put out a release saying that the average rate of interest for the year for debt service is about 10.89. That is where the rates are going to go down to over time. So it's dynamic, and you shouldn't hold on to one peak and hold on to that and say that's distortionary.
No, but if it continues over time, where
it will not continue.
It will not continue.
It's dynamic.
Okay, let's take a look at the budget. We've had a bit of a delay. Earlier this week, the finance minister did say that she and her team are looking at the details, of some of the changes that were made by the National Assembly. The oil benchmark that was increased to 72 from 70, and of course, the entire budget raised to 4.8, from 4.6 previously. Well, she says that it's normal, that nobody should, we shouldn't raise concerns, be concerned about that. What do you see happening? Because she's meant to meet with the National Assembly today. The
first thing is that expenditure is up 2%, but oil price at $125 for Bonnie Light shows that we are up 14% on oil price. So if expenditure is up 2% and revenues are up 14%, even though we cannot guarantee that it's going to be that throughout the year, there's enough headroom to make sure that there's balance.
Now, according to, apart from...
And mind you, the deficit, the fiscal deficit is coming in at just about 3% of GDP, which is the acceptable band.
Okay, it is actually. Now, would the oil benchmark at $72 per barrel, according to the debt management, according to the finance ministry, rather, they say that we'll be saving about 98.4 billion naira, and that 50 billion naira out of that money is being taken out to service debt, and that would ultimately reduce borrowing. Of course, if you have more money to service your debt, that will reduce borrowing. What do you think about that?
I think that's good. That's why I told you that if you look at the Debt Management Office release, it says that the average rate of interest for the national debt is going to be down to 10.89%, as against the current rates of about almost 16%. If that happens, then all other rates, because that's the benchmark rate which will drive other rates in the market, that will drive it down, and then cost of borrowing will reduce. But we shouldn't look at cost of borrowing in isolation. We have to look at it in the context of inflation and the inflation targeting framework which the central bank is pursuing. So basically what you want to do is to see whether there's growth, 1, 2, whether unemployment is being reduced, and 3, whether there's macroeconomic stability. In terms of stability, yes, we have monetary stability. In terms of growth, yes, growth is trending upwards. In terms of unemployment, we have work to do. So we need growth with prosperity, not growth with austerity.
So, okay, looking at the budget as a whole, if it's passed in this state, especially with the oil benchmark, is it this time an ideal budget that would have perhaps a higher rate of success if properly implemented, as it were? It
is a better budget. First of all, it's more accountable, it's more transparent. But secondly, what you must note is that the federal government portion of national economy is only about 55%. We have 36 states in the country, and that is a major source of macroeconomic stability and instability. So to judge the economy based only on the federal government numbers is to have an incomplete analysis. So we have to we go beyond that and see what the states are doing. And what are the states doing? The states are all trying to sanitize and the Federal Minister of Finance is trying to enforce the Fiscal Responsibility Act. The Security and Exchange Commission is insisting that the proceeds for which bonds were used are properly deployed before new bonds are issued. They're insisting on rating of the state bonds and the states themselves who are the issuers. These are very important things which are ignored by investors and also by the Capital Market Committee. These are things they should look at. How have monies been used for projects? Are they creating employment? Are there linkages? Right? Are they actually aspiring and meeting the objectives, broad macroeconomic objectives of the country?
I do know that the Securities and Exchange Commission has a monitoring team, and of course, before any state can actually get that kind of a issue or go to the market to issue bonds, the SEC has to approve it.
Yes, and not only that,
to inspect
for those that are issued in the past, they want to know how the money was used, and if it has not been properly used, they say so. And also, when they're used, they're the rating agencies. So there are a whole range of things, and these are very, very important and significant issues. That actually, because you find that the bond market is a very substantial part of the capital market. And institutional investors are looking at the yields in the bond market and the credit worthiness of the bond market, comparing that to what they get in the equity markets.
So in terms of growth for the bond market or activities in the first quarter for the bond market, was that any significant activities recorded in terms of growth, in terms of patronage?
No, the amount of trading and the amount of money that was used to service debts in the bond market was definitely much higher than it was in the previous quarter. What we are seeing is, if you look at the capital market, there were significant gains in January, February, and March until the probe happened. We have seen some slack in that, and then we are beginning to see a slight recovery again. Hopefully it stays this way. Who knows what happens when the probe starts again. But the reality is that the results of the banks and results of these companies have come out, and there's some enthusiasm, right? And then the pension commission has actually revised the guidelines to saying that they can hold up to 50% in equities maximum. But that's not the solution. Is that a maximum means nothing. They have 25% maximum right now, and the PFAs are holding only 9% in equities. What is required is for the pension commission to have a minimum. That means no matter what happens, your portfolio should not go below a particular level. In that case, people have to go out there and buy, wisely and prudently.
So if it's at 9%, and of course we do know that many people are still investors, even PFAs themselves are still very much shy going to the equities market, for obvious reasons. Yeah. So if you put it at 50%, I asked a guest who came here to talk about that. He was very optimistic. He was a PFA administrator himself. He was very optimistic that 50% is nothing, that they can do 50%. But I'm saying, in real terms, how realistic is that?
Well, if we have a minimum and say you cannot go below 25%, then they will have to buy.
Okay, hold your thoughts first. We need to take a quick break. Now we'll come back. We'll talk about the foreign exchange reserves and, of course, some other issues. We'll look at the banking subsector and the capital market. Also, I have been talking to Bismarck Rewane, an economist and CEO of financial derivatives company. We'll be looking at the economic performance in the first quarter of this year. We'll be right back after this break. Welcome back. We're still looking at the performance of the Nigerian economy in the first quarter of this year. Bismarck Rewane is still here. This time we're looking at the money market, and of course we'll also be looking at Nigeria's external reserves, which according to latest figures has been put at around 35.8 billion now. But you said 37.
Actually, it's gone up to
37. We haven't seen that in a very, very long time. Of course, we know where the problem was coming from the forex market. So how has that been in the first quarter of this year? Interbank rates are still high at about 15%. Well, the Naira seems to have stabilized a bit at 155.
Yes, I think basically because the budget had not been approved, because the capital votes had not been released, there has been some dearth in liquidity. Okay, and that's the position. But we must not forget one major thing. There are the AMCON bonds which will mature December next year, the first tranche, and that's about 1 trillion naira. If those bonds are going to be either refinanced or redeemed, 1.5 trillion naira is about almost 20% of money supply, because money supply is about 13 trillion naira right now. So that's a potent issue which has to be dealt with, but that's not until December next year. Now, the other thing is that the reason why the foreign exchange demand actually reduced and the reserves increased: one, the oil price went up; two, the NNPC and the PPPRA did not give the import permits to the importers. The first import started yesterday. From the NNPC was the only one importing throughout the first quarter. Okay.
I thought there had been an initial release of about 47 or receipts. 43
people were licensed,
okay,
but the actual import permits were effective April 2nd.
Okay.
Okay. So they start opening the letters of credit. They started opening it the day before yesterday. Now, therefore, there was an artificial slowdown in the demand for petroleum products in the first quarter. Not just, I don't think it's artificial. Actually, the demand, because the price went up by 50%, and most of the demand in the fourth quarter of 2011 was actually artificial. We are seeing somewhat of a natural equilibrium there. So, if you take away the oil distortion from the oil marketers, there's been a reduction in discretionary income because people are spending 50% more on the price of petrol. They have less to spend on other things. So there's been a kind of slowdown in the month of February and March. We are beginning to see a pickup again at the end of March and early April, and all of that activity will feed in to the money markets and the foreign exchange markets in the second quarter. So second quarter is going to be much more active than the first quarter, in which we witness a slowdown.
Okay, our reserves are up, no doubt.
Yes.
Good news for everybody. But we still spend billions every day importing all kinds of food items, yes, rice, sugar, wheat, and all of that. So none of that's on that arm impacted, because that usually is one, apart from the foreign exchange market, that also impacts on our...
No, the discipline of economic analysis is that you must separate incremental from fundamental.
Okay.
Okay, the incremental variables are looking good. That is inflation, foreign exchange reserves, price level, and all of that. Now, but fundamentally, the structure of the economy still remains the same. Weak linkages, low productivity, and all of that. You cannot shift and change the behavioral patterns and structure of the economy in one quarter. So we have to ask ourselves, what has happened to capital formation? What has happened to these structural issues and the linkages in the economy? One, the power PHCN deregulation and privatization has been moved from March to October. In fact, some investors are pulling out. There's been no new commitments on refineries. The deregulation of that industry is still up in the air. The subsidy issue has only been touched partially. We still have to come back to it. There are a lot of fundamental issues. One part of the good news is that our minister has been nominated now as the president of the World Bank. With some luck, we get that.
Yeah, but is that going to impact on perhaps maybe on in terms of foreign direct investments, our reputation out there, but in terms of real returns to the economy?
She'll be a champion, and you see, the levers of control of global financial flows are very, very strong. And if you are the president of the World Bank, you have a lot of leverage, just not only for Nigeria, but she's representing Africa and the entire developing world, and so that will help. either directly or indirectly.
Now, Bismarck, let's go back to the external reserves. We do know that at some point the central bank actually did diversify about 10% of the total reserves to the Chinese one. But now we're seeing a recovery in the U.S. economy. Yeah. The jobs market seems to be sustaining its recovery, and other indicators, the manufacturing seems to be picking up. Of course, all eyes had gone on to China and the emerging markets, but it looks like now that focus is shifting on the dollar, on the U.S. economy to even perhaps drive growth. So by that, do you think the central bank might have a rethink and to keep in more dollars?
No, definitely. The reality, with or without the performance of the U.S. economy, we sell 36% of our exports to the U.S., oil and gas, right? And we buy only 9% from the U.S. We import 15.9% of our imports from China, and we sell little or nothing to China. So the trade balance, the terms of trade between ourselves and the U.S. are in favor of Nigeria. The terms of trade with China are actually in favor of China. So strategically and geopolitically speaking, it's in our own best interest to maintain as much as possible in US dollar reserves. But there's nothing bad in diversification. So I think if we have gone up to 10% in one, that's about where we probably will stop. I don't see the central bank moving any further than that in the near term.
No, we're still safer with the dollar.
Oh, definitely.
Basically, it's still the world's reserve currency anyways. Let's go into the money market proper. Let's look at the interbank rates for this first quarter, still at an average of around 15% as for the core money, the short-term lending. And we've seen the OBB rate still trending at around that level also. Would you say that for short-term lending, rates as high as 15%, is that a sign of cash squeeze at the market?
That's not healthy. The point is that short-term rates, the yield curve should actually be positively sloped, and this is a reaction to the tightness, because we had a common year end for December, and then the central bank guarantees were yanked. But the moment we start seeing the capital votes being disbursed, and we start seeing a lot of this money is coming into the system, and there's some kind of sanity in the government borrowing program, then you begin to see some equilibrium begin to emerge. But definitely keep your eyes on the rate of inflation. If the rate of inflation stays at about 9.6 to 10%, there's no way that short-term rates are not going to come down to about 11. Usually there's like a 1% spread between the rate of inflation and short-term rates. Okay,
what about the act of lending among banks? I know the interbank guarantee has been taken out, so is it the healthy borrowing and lending at the market? There are no issues at that?
Because the banks, don't forget there's another stress test, or in other words, a bank audit program that will be carried out by the central bank.
I think the
banks are in a much stronger position than they were 3 years ago. So let us say, to all intents and purposes, the fundamental issues with the Nigerian banking system have been resolved, and now it's time for some further consolidation and growth.
Now, the central bank actually did embark on very aggressive liquidity mop-up in terms of issuing treasury bills, the open market operations, and the primary market auction. When money comes in from one window and then a few days later, it's out through the other window. Is that a healthy development at the market?
Well, I think that what you're going to see this quarter is more of an exchange rate movement, because the exchange rate is used as an alternative to actually mopping up with interest rates. So every time you sell foreign exchange to the Nigerian public, you actually take away naira. But I tell you something, the central bank is going to move into an interbank system. I understand that they're appointing a dealer, right? And then rather than have the weekly auction, any bank that wants money will go and buy. So there'll be a much more efficient market. So you might even see the rate appreciating sometimes and then actually depreciate. So the central bank will have to be able to intervene in the market, and the volume of intervention, the frequency of intervention will determine what the exchange rate is.
Okay, cool. Let's go into the banking sector proper. Now, like you said, it looks like the reforms, have actually, put the banks in a better position in terms of their balance sheets. Many of them are healthy now in terms of capital adequacy ratio, all of that. It's all healthy right now. And earnings, we've been having a couple of earnings, about 6 of them, but 2 of them weren't so good. But looking at what the banks have put out in terms of earnings, what are your thoughts on that?
Well, the most important thing, 2011 is behind us. There were some profit warnings and all of that, and all the figures are out on the table. But the Q1 results are quite interesting. Significantly, you see most of the banks that even gave profit warnings and declared losses in 2011 are coming up with real bumper Q1 figures. And if the momentum is sustained, I think that you are going to see a massive rush for the stocks of those banks. Primarily the 2 that have released the two that are about to release, one is Diamond Bank has released Q1 results.
Q1 yesterday,
quite interesting.
After that, very disappointing.
Yeah, but no, this...
No, but I need to ask you this.
Yeah.
These banks were, it's 2009, between then and now, it's thought that many of the banks had gotten rid of their non-performing loans and exceptional items. But at this stage, one just wonders for a bank like UBA and Diamond Bank why they were still having such dealings with the AMCON, selling non-performing loans or making provisioning for exceptional items as well.
No, I think that's a static analytical point of view. A loan that was good last week can become bad because of new developments. So you've got to be dynamic. So those loans that were being provided for in 2011 were probably performing in 2010. And so some of the loans that are good today are going to be bad tomorrow. So that is why you need capital adequacy, so that to prepare yourself for downturns of exogenous shocks. And in the US has just conducted a stress test on 19 banks, and I think 5 of them did not pass. But the stress test is not based on its current position. It's based on the future simulation that if the economy was to deteriorate, and some of these loans that are performing now become bad, do you have enough capital to support your operation and not jeopardize shareholder and depositor interest? That's how it's done.
So we shouldn't have fears about that happening, because if it could happen to a UB or a Diamond Bank,
No, look, that you should be happy that they put everything
out there.
The worst thing is to start concealing these things. Mm-hmm. Concealing a material fact is more dangerous than putting it on the table.
Okay.
What you know is what you what you can deal with. What you don't know is what gets you,
Absolutely. Let's go over to the capital market now. Of course, very major for the economy. The all-share index, or the broad index, for the first quarter down 0.09%. We had a good, bittersweet as it were, first quarter run for the capital market. We've seen the earnings driving activities of the market, but disappointingly, it still ended down in the negative.
Well, see, the capital market is work in progress. Let's take it. What are the initiatives? One, transparency and sanitization of the market. The Securities and Exchange Commission intervened. Obviously, when you intervene in the market and stop all the shenanigans that are taking place, people react and people don't like it. They're used to a laissez-faire attitude. That's there. Secondly, it's coinciding with the time when there was a global meltdown. Thirdly, retail investors that lost so much money, they have no incentive to come back into the market. So we've got to what you call a low of all times. There's volatility at the bottom of the market, the price chart, and now we are beginning to see some very steady creep up. Now, what is happening? 70% of the investors in the market today are international institutional investors. Another 20 to 25% are domestic institutional investors. If the domestic institutional investors are only putting 9% of what they're allowed to do into the market, therefore, there's uncertainty. They want to be sure, one, what are the numbers? Two, are the numbers credible? Three, are the regulators serious about this zero tolerance for infractions? Once the answers to these questions are satisfactory to the investors, you'll find that they start coming back. Are they going to come back with their 2 feet and 2 hands at the same time? No, they're going to come back gradually. Now we are beginning to see that the stock exchange itself has started approved market making.
Yes, I was going to come to that. What significant change are we going to see? Because it's something that's been clamored for a very long time, and it's happened. According to the NSE, there will be more liquidity in the market. The market will be deepened. How soon should we expect an impact on the market?
Okay, let me take you through the sequence of how markets recover and how markets. One, markets have to be transparent, right? And healthy markets are transparent and disclosure total. Second is that markets become efficient. Price discovery and trading and all that done efficiently, so that when people know that the information is accurate and there's no infractions, and then they begin to buy and begin to make prices in those. Then the market goes from healthy markets, transparent markets, to efficient markets to sophisticated markets. Market making and short selling are sophisticated variants of an efficient market. So you're going through this very quickly, and you'll find that the prices begin to recover and become strong, because everybody knows that the information I'm getting is transparent and honest. Secondly, the market is efficient. And thirdly, sophisticated investors can now begin to take positions. That is how the market is going to recover. So expect in the second, third, and fourth quarter some very solid. Any recovery you get is not a recovery that is just
based on speculations,
based on
one
speculation.
step forward, 2 steps
no,
back.
No, that's not going to happen. So you find that there'll be, I think you are going to see interim results, you're going to see interim dividends, and you're going to see fundamental investors coming back to, quite frankly, a lot of people are interested. So I won't be surprised to see a major recovery in market prices.
Looking at the earnings that have been coming out, many of them have actually been impressive, but then since we do know that 70% of this market is in the hands of foreigners, this cash dividend payments coming out, does that mean that it's going to go to the foreign? Most of it will go to the foreign investors, as it were.
Institutional investors don't make investment decisions based on dividends. They make their decision based on shareholder value.
Okay.
So as a matter of fact, the more you harvest your dividends, the more worried they are that you are not retaining enough earnings to develop the business.
Okay.
So the high dividend policy and strategy is actually counterproductive to institutional investors.
Okay, so overall for this first quarter, how would you rate the economic growth? We're still having a GDP growth of between 6 and 7%, still in line with the expectations?
Oh yes, definitely. The growth is not the problem. It's the prosperity that is the problem. You have unemployment at 23.9%.
Creating jobs and all of that.
Right. Okay. So growth without prosperity is nothing. It's still a lot of work to be done. But first of all, you must grow. Then secondly, begin to talk about income distribution and begin to talk about structural and fundamental adjustments to the economy. That is why the reform-oriented programs, which is all-inclusive from all areas, need to be pursued, both at the federal, state, and the regulatory level, to make sure that the reform, if the economy is not reformed, then we are all going to have difficulty. We'll have this growth. The growth can come down tomorrow if the oil prices drop, if production is disrupted. But if it's fundamentally structured, you'll find that in spite of exogenous variables and shocks, the economy remains strong and balanced, and the future will look much better than the present.
Well, perhaps we'll have a better run in the second quarter of this year, especially by then, obviously, the budget will be fully on course for implementation.
Definitely.
Well, that's about all we can take at this time. Thank you so much for being here. Thank you for your contribution. I have been talking to Bismarck Rewane. He's the Chief Executive Officer of Financial Derivatives Company, one of Nigeria's leading financial services companies, and we have been looking at the economic performance of the Nigerian economy in the first quarter of this year. Now, before we round up the show, let's quickly check with the latest earnings that we got from Customs Street yesterday. Let's start off with Dangote Cement. Its full year ended 2011 earnings. Turnover came in marginally higher, up 0.09% at 235.9 billion naira. Profit before tax also came up higher at 118.2 billion naira, while its net profit also rose over 0.34% at 125.9 billion naira. Fixed assets are also up about 25%. The company is proposing a cash dividend of 1 naira 25 kobo and a proposed bonus, well, it's 1 for 10 cash bonus share of 1 for 10. That's 1 new share for every 10 shares held by investors. Payment date is the 1st of June this year. Closure dates between the 14th and 18th of May 2012. The next AGM is that's the annual general meeting will hold on the 24th of May this year at the Civic Center at Victoria Island. Let's take one also from Julie PLC, one of the small companies listed on the exchange. Turnover dipped down 15.1% to 211.1 million naira. Profit before after tax actually came in at a negative of 51.4 million naira. No cash dividend, no bonus from the company. However, fixed assets are up 3.6%. But those are the latest earnings we've got from the Nigerian Stock Exchange, from the companies, many of the companies listed on the Nigerian Stock Exchange. On that note, we'll wrap up today's edition of Business Morning. Thank you so much for being a part of it. Channel's News Track is at 11. I'm Esther Obodaga. Bye for now.